Hello everyone, we are back in Edinburgh now with Zehrid Osmani, manager of the Martin Currie Global Portfolio Trust. The trust is unusual amongst its global peers in that it pursues a highly active, unconstrained approach to global equities, which exclude many of the mega caps, which are household names to investors. Zehrid, who leads the global long-term unconstrained team at Martin Currie, became sole manager of the trust in 2018 and made a strong impression since he took over, delivering NAV total returns of 75% over the last 3 years, and leaving the trust ranked third out of 16 trusts in the AIC global sector. Zehrid has achieved this without using gearing, whilst also keeping a firm grip on risk, and the lack of mega-cap global names in the portfolio, with the notable exception of holding in Microsoft, means the trust offers significant diversification benefits. I am very pleased to hand you over to him now.
Thank you, Pascal, and good afternoon, everyone. Thank you very much for joining us. We wanted to give you some quick highlights about what we do within the Global Portfolio Trust, and then moving on to how we find growth and where we find growth. So the first point about the introduction of Global Portfolio Trust, there are 6 aspects we wanted to highlight. The first one is that our approach is high conviction investing in high quality growth companies. We typically look at companies in the 25 to 30 range. We're currently at 30 holdings, so we've gone very concentrated, and the top 10 account for 46% of the portfolio. So very high conviction investing, and we're focusing on companies that generate positive spreads between their returns and their cost of capital, that have pricing power and barriers to entry. The second point is we're fundamental in our approach. So how we find those companies is fundamental analysis, which we do in a great amount of depth, breadth, but also with consistency and structure. And you will see that we have some proprietary assessment of mega trends to ensure we put our clients' assets on structural growth opportunities. The third point is portfolio construction, which for us is paramount as part of managing the trust. We are stock pickers, and like many stock pickers, we focus on finding ideas and research them. But unlike some stock pickers, we also put as much emphasis on portfolio construction as we do on step 1 and 2 that I just mentioned. And the importance of that is to ensure no unintended risk exposures. We have some very innovative ways to assess fundamental risks in the portfolio to ensure diversification in as little as a 30 stock portfolio. Fourth point is ESG. ESG is at the heart of what we do. At Martin Currie, ESG is something we've been focusing on for over 20 years now. We have a AAA+ rated by the PRI for the 4th year in a row, which sanctions that expertise. And we have actually elevated that ESG leadership to a higher level with some proprietary ESG risk assessments that we're also going to show you in a moment. And we are a truly global equity portfolio, which means that we are able to capture the best ideas globally without any restrictions. And we have the benefits of an investment trust structure with gearing that has been adopted in Q4 of last year by the board. That gearing is structural, and it's something that we plan to continue to hold for the time being. We have low charges, no performance fee anymore, quarterly dividends, and a 0 discount policy, which is something that is supportive of the share price. On the ESG side, we wanted to highlight 6 differentiators. The first one is that we're the highest rated and the sole holders of 5 globes under the Morningstar sustainability rating. So truly strong focus on sustainability as a trust. Secondly, we're in the top 2% of all the products categorized by Morningstar as global equity large cap. Thirdly, we have 52 ESG proprietary risk assessments that we carry on every company to ensure that we put our clients' assets on sustainable business models. Furthermore, we're rated one of the best in the sector on social factors, again by Morningstar. And this is an important focus for us. And we've got an additional 20 parameters that we're assessing every company in terms of social exploitation risks. Furthermore, I mentioned that we have a AAA+ rated by the PRI for the 4th year in a row. We're also in the top 9th percentile worldwide for active ownership, which is the most difficult part to get, showing that we actively engage with companies that we're invested in. And finally, we have a low carbon footprint. The trust has been awarded a low carbon designation and accounts for only a fraction of the emissions of the benchmark. So how we find growth? We're going to run you through some of the key pillars of our fundamental research. The first one is the assessment of fundamental risks that we carry on every company that we research across 4 verticals: industry risks, company risks, governance and sustainability risks, and portfolio risks. The reason we're structured and detailed in that manner is to bring in consistency in our fundamental assessments and to ensure that every investment risks that are relevant to assess have been assessed by the time the research is coming in front of us. It also permits us to effectively have a checklist in the same way as a plane before takeoff to ensure that there's no disaster on takeoff. If you look at the detail within each of the verticals, you can see that we go very detailed on industry dynamics to ensure that we put our clients' assets in companies that operate in industries that have favorable dynamics for value creation. Within that industry risks, at the bottom, you can see that we are assessing supply chain risks. This is something that has become an important focus by the market now since the pandemic crisis. This is something that we already had in place prior to the crisis. So the importance of being detailed to ensure that we're crisis ready is an important aspect. When you look across company risks, there's various aspects we're assessing. Cost-based inflation that's impacting companies, which again is relevant for the time being. Workforce risk, given that some sectors are suffering from shortages of skilled labor. But also accounting risk is important to us. We only invest in companies that have strong accounting practices as a way to protect our clients' assets. I usually finish by highlighting that Warren Buffett once said that risk comes from not knowing what you are doing. By having this detailed, structured, consistent assessment of risks, we eliminate that risk. As a result, the typical type of companies that we invest in are companies that operate in industries with high barriers to entry. They tend to have dominant market positions or the potential to be dominant. It gives them a strong pricing power. They have low disruption risk in an ever more disruptive world. They have structural growth prospects, high returns, strong cash flows and solid balance sheets. And on the ESG side, quality management, good corporate culture and sustainable business models. But importantly, at the heart of it, attractive valuation. Very quickly on ESG, this is the detailed 52 parameters that I mentioned earlier. We're looking at governance, which is the column on the left, sustainability, the column on the right. Top tables fit from the tables further down. And you can see that on governance, we have a very detailed list of assessments of the board, management, remuneration, and culture. And on sustainability, we assess environmental, social risks, understanding of those risks and integration into company targets and ambitions, as well as assessing every company across 5 common factors, which are climate change, cybersecurity, human capital, customer trust, and taxation. By having this very detailed and structured assessment, we can zoom in on areas of risks and engage with the management to drive positive change. We also assess each company in terms of momentum on governance and sustainability to capture companies that are improving rapidly on those fronts. In terms of long-term structural growth opportunities, we have in place a thematic framework to assess the portfolio in each company. We have identified 3 megatrends: demographic changes in blue, future of technology in green, and resource scarcity in black. These are megatrends we will be talking about for many decades to come. There are themes within each of those megatrends, which we've listed on the left and on the right, also color-coded. What we do in the fundamental analysis on each stock is we assess which themes is each stock that we're researching exposed to and to what extent. It means that at the end of the process, we can aggregate the data at the portfolio level, which is what this shows you, to assess how is the portfolio exposed to the various themes within those three megatrends. It gives us the ability to do three things. Firstly, we know the portfolio more accurately. Secondly, we can manage diversification and risk exposures more efficiently. And thirdly, we can point the research where we need to do more work, whether it's a theme that we haven't researched, which would be apparent here, or a theme where we want to gain more exposure, providing that valuations make sense. Importantly, this permits us to put our clients' assets on long-term structural growth opportunities. So where we find the growth is an important area as a result of this megatrend. We have highlighted 8 areas of opportunities in the post-pandemic world, which we're listing here. And you can see from the logos on the side which themes or which megatrends each of those are located in. On the left-hand side, there are 4 areas that are exposed to infrastructure. The recovery from the pandemic has been driven by a sizable fiscal spending globally. Some of those fiscal spending is being channeled in infrastructure. This opens up some attractive longer-term opportunities, given that infrastructure spending tends to be a long-duration investment. So renewable energy is one area of interest because most governments are focusing on decarbonizing their economies. Secondly, electric transportation, another form of green initiative. And in this instance, both high-speed railway and electric vehicles are areas of potential structural growth opportunities. Thirdly, 5G telephony, in order to make economies more productive. And fourth, healthcare infrastructure, given that coming out of a pandemic crisis, there is a need to upgrade the healthcare infrastructure, both physically, but also in terms of increased digitalization to increase productivity. On the right-hand side, there are 4 additional opportunities structurally that were present previously, but that have accelerated since the pandemic. The first one is cloud computing. As more businesses have migrated their activities online, has increased the structural growth of cloud computing. And as a result, cybersecurity has a need to protect that presence online. Secondly, robotics and automation. As companies are coming out of this crisis, they realize that there is a need to make their production lines more robust and their supply chains more resilient. As a result, an increased investment in robotics and automation is an important area. Thirdly, online education and online gaming, because these are areas that have recruited so-called new subscriber bases during the lockdowns. And finally, hygiene, both food hygiene and domestic and professional premises hygiene. We wanted to run you through a few stocks that give us exposure to that. And the first one is Atlas Copco, which is a leader in vacuum and air compressor technology. This is a company that sits within the industrial space. And the way we look at this, all the companies, is returns and growth profiles. We look at them in terms of geographic exposure, in terms of end user market exposure, and in terms of type of companies they are. And in the case of Atlas Copco, this is a company that's well exposed globally. In terms of end markets, you can see that the exposure is across industrials, technology, autos, and construction. And if you look at the returns profile of this company, it's really exciting because it generates a return of 22% on our forecasts. So this is the last reported number. And we forecast that to go to 38%. So a company in industrials that generate high returns. Importantly, it has more than covered its cost of capital through the worst of the recessions historically. So while cyclical, it's a quality cyclical in our view. And in terms of growth profile, we forecast that company to grow at 8% per annum on revenues and at 12% per annum on growth. Gives us exposure to urbanization, to infrastructure, and indirectly to growth in emerging market middle class. We classify this as a high growth, high return company. Importantly, it is exposed in the air compressors to the various areas of infrastructure. But on the vacuum technology side, it's giving us exposure indirectly to the semiconductors. Because in order to build microchips, you need clean chambers free of dust. and the vacuum technology that Atlas Copco provides is a leader in that space. We wanted to now move into consumer, Moncler. This is a company that's effectively in the luxury space. And what we like about Moncler is this is a brand that is still underexposed, that still has opportunities for more doors opening. And therefore, if you look at the top line growth, we're looking at 17% growth annualized over the next 5 years in revenues, feeding into 15% growth on earnings over the next 5 years. Geographically well exposed, clearly China and the Chinese consumer is an important exposure. And it gives us that exposure to the growth in emerging market middle class in particular. And returns-wise, it generates returns in the mid-20s, which are very steady. So this is a company that has got very strong creativity, very strong brand momentum. One of the campaigns that they've run recently, the Moncler bubble on TikTok, generated more than 6 billion views, which shows you the attraction of that brand and the momentum and the vibrancy of the brand. We then wanted to move on to the third company, which is Ferrari, consumer, but autos really. What's exciting about Ferrari is in an auto sector that only generates about 5% returns. This is a company that generates 27% returns. We forecast that to grow to 47%. Well exposed geographically. Clearly, the emerging market consumer is an important driver structurally. Strong pricing power as a brand, strong brand recognition, long waiting lists, which means that they can really weather the cyclicality of the sector ultimately. We forecast 13% revenue growth and 19% earnings growth per annum over the next 5 years. So again, this is a high growth, high return company. We believe that this company is going to make the transition to electric vehicles successfully, given its superior R&D and innovation, as they've shown in Formula One. So an exciting stock that's got an exciting future in our view. We then move to the semiconductor space in itself. TSMC, clearly one of the leaders. And what we like about that industry is the high returns, 38% return on invested capital, top line growth of 15% annualized over the next 5 years, and earnings growth of 11% annualized. Again, well exposed geographically. In terms of end markets, it's a combination of consumer discretionary, telecoms, industrials, technology, and autos. We call this company a steady value creator, really well positioned leader in its space and able to harvest those attractive growth profiles through high returns. And it's exposed to robotics and automations, to electric vehicles in particular as a highlight. We wanted to now move into construction. Clearly, green initiatives is an important area of infrastructure spending, focusing on that transition. And efficient buildings is one important aspect, given that buildings are big emitters of carbon emissions. So this is a leader in panel insulation, and therefore energy efficiency in the construction segment. You can see from the end user market, it is a construction exposed company, globally well diversified. And again, what's interesting for a construction company, generating high returns of 13%, which we forecast to go to 23% by year 5 of our forecast, with a top line growth in the mid-teens and a bottom line growth of 20% annualized. So again, another high growth, high return company, well positioned to capture the increasingly more stringent regulatory frameworks that are implemented across geographies, asking and demanding of building construction to bring in more insulated panels in their buildings and in their homes. Then we wanted to move on to healthcare. And in healthcare, we wanted to highlight Masimo. Masimo is a leader in the non-invasive patient monitoring space. And it's one of these devices that patients get clipped on their finger to monitor their vital statistics. Effectively saves lives. And it's a leader in that space. It's a two-player market with roughly 50% market share for both players. Massimo actually grabs 2/3 market share of new orders. So it is grabbing share because it has been more innovative in its R&D. And if you look at the returns profile of that company, mid 30% returns, which we forecast to be stable, revenue growth of 11%, and earnings growth of 10% per annum. So we call this a steady value creator, but really well positioned to capture the trends towards increased remote patient monitoring, such as introducing these devices in retirement homes and elderly care homes to be able to monitor that vulnerable population remotely rather than getting them to come into hospitals. And we wanted to then talk into technology. This is the last example, NVIDIA, which is a leader in graphics cards. This is a company that has a very strong long-term structural trend coming from gaming and also data, and therefore exposed to the cloud trends. Very high return on invested capital at 47%, which we forecast to go to 85% by year 5. Revenue growth of 28% annualized over the next 5 years. Really explosive growth, feeding into an earnings growth of 32% annualized. Well exposed geographically, and in terms of end user markets, clearly consumer technology and autos are the important end markets. But ultimately, this is a company exposed to data, to gaming, to cloud computing, and robotics and automation. We classify this company as high growth, high returns. So we wanted to very quickly highlight risks in the market on the top-down basis. 7 risks that we highlighted in our outlook at the back end of last year. 4 of those are particularly relevant. Taxation being one of them, increased taxation on corporates and households. In our forecasts and the numbers we've been quoting you on these companies, we've already captured a 300 basis points increase in taxation globally, because this is a likely outcome ultimately over the next years to come. Pandemic relapse risk is something to bear in mind. Clearly localized disruptions as some economies partially go back into lockdown. And this is really the market needing to live with the fact that this pandemic is moving into an endemic. We see occasional localized lockdowns. Asset price bubbles is an important aspect. Given the low rates environment, it has created more risk of asset price bubbles. So it's important to be disciplined as an investor in terms of valuation, something that we apply across all of our research. And of course, the inflation is an omnipresent debate. For us on the inflation front, what we wanted to highlight is 2 points. Firstly, we're going through the lowest base effect and the highest frictional inflation. So it's important for investors to not make rapid conclusions at this point in time on whether inflation is structural rather than just temporary. And we believe that's not something we'll be clear on until the summer of next year, given the more prolonged disruption to the supply chains that we're going through. Also, the largest majority of inflation comes from wage inflation, typically 80%. And at the moment, wage inflation, whilst picking up, is not deviating from trend at this point in the cycle. But that is the area we would be watching at. Other areas of risk, clearly increased indebtedness, which typically tends to be followed by lower growth prospects. And that's something to think about in the long term. Geopolitical risks where tail risks have lowered, and fiscal stimuli, given how important they are to the recovery. There is therefore an execution risk from implementation of these policies that we need to be mindful of. So in terms of delivering growth in the trust, what we wanted to highlight is a few aspects. So here is the 12 months rolling performance. And indeed, we're very pleased that in 2019, we were best performing trust, and 2020, we were on the podium effectively as 3rd best performing trust. But importantly, this is showing a steady creation of alpha, which we're very pleased with. Importantly, at the bottom, you can see an upside capture of 103%. So able to perform positively and outperform rising markets. whilst we have a downside resistance of only 81%, so really resisting in down markets. And that upside capture and downside capture really highlights that we are positioned for an assumption of a positive economic cycle, given our 5 to 10 year time horizon. That is important to highlight, and therefore exposed to be performing well in a positive economic cycle, but at the same time resisting in periods of market sell-off because of the type of companies we're holding. And that focus on finding best ideas across the globe has shown into a strong performance in both the share price and the NAV on the left-hand side since my tenure, but on the right-hand side over the long term, which has also been a strong momentum. What we're excited about on this slide is actually the shape of the portfolio. So this is on aggregate what the portfolio looks like on fundamental numbers on the left-hand side. What you can see there is solid balance sheets with a net debt to EBITDA of -0.1, so on aggregate net cash positive companies. And we also like the growth of any company to come from revenues, not just profits. And this portfolio is forecast to generate a 14% annualized growth in revenues over the next 5 years, compared to a market at only 8% over the next 3 years. And that superior growth keeps delivering on earnings, dividends, and cash flow. Importantly, on the right-hand side, this is a portfolio that generates a return on invested capital of 25% compared to a market at 7%. This is the last reported number. We forecast that ROIC to go to 91% by year 5. We don't have an estimate for the market given consensus doesn't go out 5 years. But really, the point here is that we're delivering a portfolio of solid balance sheets with strong growth both on revenues, profits, and dividends, high returns and rapidly improving returns, which makes us confident that no matter what market environment on a rolling 5-year basis, this portfolio should perform strongly. We wanted to finish with sector exposures. On the left-hand side, you can see the sectors we don't like. We're not exposed to utilities, real estate, energy. Telecom stock is a tech company, actually. We've got a big underweight in financials because we don't have any banks. So really, that's that unconstrained approach, not putting our clients' assets in areas of the market which we believe will struggle to create value in the long term, and really focusing more our exposure into 4 important sectors: technology, healthcare, consumer, and industrials. Within healthcare, we've got no large cap pharma, no pharmaceuticals, in fact, it's all medical technology. Bottom right-hand side, you can see that we're underweight market caps over 50 billion, therefore overweight below 50 billion. And at the top right-hand side, you can see our sizable underweight to the US equity market. We've got none of the FANGs, which Pascal mentioned earlier. And really, we find better value elsewhere. And at the moment, we find better value in Europe and Asian equities. And finally, our top 10 holdings, which we mentioned, account for 46% of the portfolio. What you can see there is a good mix of exposures between healthcare, technology, industrials. You don't see any of the consumers, but further down, we've got good exposure to consumers, notably luxury, with names like Moncler that we mentioned, but also Currie, and we also have exposure in the staples to L'Oreal, which is a stock that has been performing very strongly, but that we continue to like. And with that being said, Pascal, we are back to you with Q&A.
Hiya. Trying to get my video working, which I will struggle with. Yeah, so we've got a few questions have come in. What new opportunities have arisen as a direct result of the pandemic, and have any previously attractive themes in the portfolio ceased to be attractive or become less attractive during the last couple of years?
Yeah, so it's really kind of going back to the slide about the post-pandemic opportunities that we've highlighted there, notably on the infrastructure spending. And the way we look at infrastructure spending is not necessarily going directly onto the renewable energy, for example. We think renewable energy as a space can be quite competitive because of two dynamics. One, you've got new entrants that are solely focused on renewables, and you've got the so-called fossil fuel companies that are clearly realizing that there's an existential crisis and a need to shift away from fossil fuels toward renewable. They're therefore bidding up some of the projects to levels that we feel are going to lead to a struggle to create value. So we prefer to look at companies that are exposed to the enabling of renewable energy, so the picks and shovels, in effect. So Atlas Copco is a name that's well exposed. If you want to build a wind farm, you need the compressors, and that gives you that exposure. So that's really the type of companies, or the semiconductors companies that you need to operate some of those technological devices. And the same holds in electric transportation. And I think we've got a slide there. So I'm going to go straight there. Our approach to assessing themes is through an ecosystem analysis, where we look at the whole ecosystem and we look at finding the best opportunity. No, we don't have that slide, so I'll just describe it. Being at the forefront of the consumer is always risky because you expose yourself to consumer choice risk. So when we look at the auto sector, we don't want to make a strong call on whether Tesla is going to sell more cars than VW or Ford. What we want to be is further up that ecosystem, further up the value chain in companies that provide components to the cars. And that might be operating in niche segments. And usually there's actually higher returns in those areas because they're in niche segments that are protected from competition. It gives them more pricing power and therefore higher returns. So I mentioned the auto sector generating a 5% ROIC, yet we find companies in the technology and connectivity space that is needed in cars that generate returns into the 15 to 35% range. Companies like TSMC, for example, or other such companies. And the consumption of microchips in cars has gone up eightfold from the traditional car of 10 years ago compared to the car of the future that is fully autonomous, fully electric. So it's that type of approach, but that's certainly an area of opportunity. And we did mention the healthcare infrastructure. So not only is there a need to rebuild the healthcare infrastructure, but there's also the structural dynamics of aging populations with more need for healthcare generally. So there's been a lot of opportunities like that. More recently, we purchased Autodesk, which is a company that's in the technology space, but actually sells to the construction segment. It effectively sells to architects to enable better project management of big construction projects. Construction projects tend to overrun by 30% on average, which creates a lot of carbon footprint effectively and wastage of materials. And increasingly more regulators are mandating big public projects to be using those software to minimize those project overruns, to get better project management, better handover from architects to contractors to subcontractors. Mm-hmm. So that's the kind of recent opportunities that we find. In robotics and automation, again, there's some very interesting areas. We forecast robotics and automation to grow at 15 to 25% annualized to 2030, with some areas of robotics like cobots growing at even a higher rate of 40% annualized. So fertile ground there. I forgot to mention on electric vehicles, we forecast a 30% annualized growth in electric vehicles to 2030. So again, another very attractive area.
There's a couple of questions that come in about the sort of concentrated nature of the portfolio and the fact that you avoid certain areas. And I think it's worth asking them all together. So fintech has been a good area to invest in, and someone's mentioned Aiden, PayPal, etc. As things that perform very well. And obviously you've not been exposed to the FANGs, and that's a thing that's quite well known. You know, most people are following the fund. What is the sort of hypothesis behind that, or the philosophy behind that, and can it be a risk in itself in that you aren't able then to benefit from their performance when they do well?
Yeah, so the reason we're not exposed to the FANGs is fundamental in each of the letters. And part of it is about the fact that we can find better opportunities in other areas, and better opportunities in terms of either as good a growth profile, if not better, and as good a returns profile, if not better, than some of these companies within the FANGs. On the fundamental side, there are some areas of the FANGs that are challenged in terms of competitive pressures, names like Netflix, where there's a strong focus from companies like Amazon Prime Video, Apple TV, but also Disney and the likes that are focusing on focusing on generating more content and therefore putting pressure on returns. In the case of companies like Facebook, we feel that they're challenged in terms of subscriber growth, and therefore will struggle really to renew that growth momentum. In the case of Google, we have some reservations and uncertainty around regulatory threats, looking at that quasi-monopolistic position that they're in. So there are different fundamental reasons why we prefer to look elsewhere. In the case of Apple, we're exposed to the Apple ecosystem indirectly through some of the components to the Apple value chain. So that's really the reasons why we are not exposed to those names.
A more basic question, but an interesting one, is how do you, given that you're a global fund and you obviously are investing all over the world, it would be difficult to staff the entire world with analysts to provide first-hand information. How on earth do you gather the information together, and how can you get a competitive advantage against other people?
Yeah, that's a good question. So basically, because we focus on companies that generate a positive spread, we already eliminate quite a bit of the market. And really, what we wanted to highlight in the appendix is, I don't know if we've got that slide. We don't, but if you look at sectors that generate a positive spread between their returns and their cost of capital, for us, it's the ones we focus on: the industrials, healthcare, consumer, and technology. And so, yes, the challenge is always finding enough time to research all the companies, but by being structured in the screening and then focusing on companies that are well governed and have sustainable business models, can really narrow it down and really just focus on the very best out there, which then explains that downside resistance that we have, because we very much focus on companies that have got long-term sustainable business model, strong governance, attractive growth and returns profile, and that are also attractively valued. The valuation is always an important aspect, because there's always a risk that this type of businesses get overvalued by the market. So we have a very disciplined valuation, a very high hurdle rate to find a company attractive, and that makes it somewhat conservative, but at least it gives us that downside protection.
Just to finish that off, you lead the a sort of broader strategy for Martin Currie, don't you? And, can you just talk about what that is, what the resource behind that is, and what the impact of the Martin Currie and Franklin Templeton coming together has been, if anything?
Yeah, so in terms of investment process, nothing has changed. In terms of our ability to manage the funds in whichever way we want, nothing's changed. So we don't have a CIO that suddenly tells us which direction to go or how to position the sectoral exposure. What we've benefited from this merger is actually the reach, distribution reach, and also the ability to look at some data providers that we might not have looked at before, that can enhance our insights, or that we can acquire at lower rates. So that scale economies that we have from being part of a bigger group is something that we're looking into.
And someone else has asked, given the, well, I mean, I'm assuming that the reason they're asking is, given that this is a global portfolio, and for many people that is a kind of core holding, and something they'll hold for a long time. How dependent on you personally is the process, and to what extent, if you were to decide to go and join the Philharmonic Orchestra or whatever you might do, stop being a fund manager, would things change greatly? Is it all you, or is there kind of process embedded in a broader team? How are you supported?
Yeah, we have put in place a process that's very structured, as we highlighted, and the team resources have been greatly enhanced. So since I joined, we moved from a team of 5 to a team of 9. So we're much better resourced, in fact, appropriately resourced for the type of investment ideas that we're looking for. So it's very well-resourced team of 9 with a combined experience of over 100 years, with good generational diversity ranging from 5 years to 28 years of experience. There's also good generational diversity with, good cultural diversity with 5 distinct cultures in the team. I'm myself French with Eastern European background. We've got a Russian, we've got an Italian and an American, as well as British people. That gives us that cognitive diversity that we are very much valuing. As part of that, we also have a very structured process in terms of assessing companies, as you've seen, in terms of fundamental risks. And on the portfolio side, we also have a very structured assessment of portfolio exposures in terms of thematic exposures, geographic exposures, end user market exposures, and the type of diversification it brings into the portfolio. And then culminating into assessing conviction so that we only deliver highest conviction stocks. So as a result of all that, we're confident that we can function efficiently. From my point of view, personally, very excited about what we can do with Global Portfolio Trust, and very much looking forward to the next 20 years before even thinking about retiring. So really a lot of very exciting years and decades to come, hopefully with strong generation of returns for our shareholders.
Does the concentrated nature of the strategy make it more volatile than other global funds?
Nearer term, you could think that it can make it more volatile, because if we've got 30 stocks, you only need 2 or 3 stocks to have a bad quarter and you get some increased volatility. However, for us, volatility alone is not how we look at it. We look at a 5 to 10 year time horizon. And yes, in the shorter term, things can be volatile. But if we do our work properly and we capture companies that have high returns and high growth profiles, the market will only need a couple of years, let's say, of showing that these companies can generate those returns to realize that they're undervalued. So while near term there can be volatility because no one can predict market moves in any given share price, I think that given time for this portfolio, it will really work for it in terms of the market realizing that these are outstanding companies that aren't priced properly.
Another question, and there's a few questions about China, but just kind of get them all into a cohesive order. The Taiwan Semiconductor is one of your holdings, and obviously people are seeing lots of headlines about China and airplanes flying over the sea and generally bothering the Taiwanese. Are you concerned about the escalation of tension in the area? You've got exposure to China in the portfolio itself, but it's underweight. Do you think that is going to go down further? And what about the indirect exposure you've got to China? And what's your view in that whole region, basically? Is it somewhere you think things are going to get better, or are you concerned about the outlook there, also specifically Taiwan?
Yeah. So China is an important area of focus for investors and should be, because China generates a third of the global growth. So it's an important area of focus for any investor. It's increasingly turning towards a demand-driven economy, so consumer-driven rather than industrials. And that's why we like luxury goods in particular. But at the same time, the importance of focusing on the geopolitical risk is absolutely relevant. It's probably the biggest left field risk in the market, the China versus rest of the world tension related to Taiwan. Indeed, that can be an important aspect given China's claims on the territory and ambitions to unify its territory. So there is an element of assessing that geopolitical risk. Our listeners might know that TSMC has been opening plants in the US, starting to build a plant in Japan, and Europe is also looking at inviting them through subsidies to have a plant in Europe as well. So that element of diversification of production sites also shows you that there's an element of consideration by governments about what could be a potential geopolitical risk. So it's something to bear in mind. It's something we're assessing as part of the investment case. But ultimately, in terms of China exposure, we look at it on an underlying basis in terms of how much of the portfolio is exposed to China in terms of revenues and profits. And at the moment, we're about 3% underweight on profits. So something that has not been an area of discomfort given the volatility that the Chinese market has had. And in terms of economic momentum, I know some in the market have been worrying about the loss of economic momentum of the Chinese economy. We think that's temporary. We think that will pick up again. And actually, our view on the economy globally is one of a more prolonged positive economic cycle. And the reason for that is so much of that economic growth is driven by these infrastructure programs. And the infrastructure programs have long duration, which means that we could be facing that longer positive economic cycle.
Fantastic. I think that's all we've got time for. Our next session is with BB Healthcare at 2 o'clock, and I'm sure in the meantime everyone is keen to get away and have a bit of lunch. If you're not registered for the next session, you can just log on via the website homepage and you can gain access to it then. In the meantime, thank you very much, Zehrid, for a really fascinating presentation.
Thank you.
Cheers. Bye.